So while he gets that set up, I'm going to give you a little preview of what I'm going to talk about. I'm going to tell you a little bit about Emergence Capital. I'm going to discuss, I get a lot of questions about, am I ready for venture capital? What kind of financing should I be seeking? I'm going to give you kind of a framework to think about that, and also address specifically what we look for in sales traction, which I think is relevant to this audience. So, and then I will have lots of time for questions.
This is forward, backwards.
Forward, backwards. Okay. And I'm going to tell you right now, if I don't get many questions, I'm going to make you all stand up again. So get your questions ready. So let me tell you a little bit about Emergence Capital. We are an early stage venture capital firm based in San Mateo. We focus 100% on B2B solutions, and we focus 100% on cloud solutions. So we are a focused firm. We only do one thing, but we try to do that very well. We love market leaders. We've learned that market leaders really make the best investments, and they're also kind of strategic companies because they have a much broader effect on the ecosystem than companies that are number 2 or number 3. So some of our investments include Salesforce.com. That was our first investment. They are obviously a gorilla in the CRM space, and that's obviously been a great investment for us, and also just has a major impact on the software ecosystem. We've also invested in SuccessFactors, as you know, SaaS in the HR world, and we love the fact that they were bought by SAP and has become the cloud platform for all of SAP. So again, that's really a great feeling for us to back entrepreneurs that can have that kind of effect. We also invest in Yammer, also having a major effect on the way Microsoft thinks about their business going forward. EchoSign, and then some of you may have noticed we had an IPO yesterday, Viva Systems, so we're kind of happy about that one. Thank you. Believe me, no one's happier than me. And then we have a lot of great companies that are not yet as famous as some of those, but we also believe are emerging market leaders, companies like InsideView, which Heidi just presented from, and Box, which is presenting later, and others as well. Here's our team. We are not a giant team. We've got 4 partners and a few other folks on our investment team. We just believe that we can make better investments and we can help our companies better if we stay small. We get very deeply involved in our companies, and we want everyone on our team to be involved, so that's kind of the way we've chosen to build our firm. One of the things we've heard recently from some of our companies is the Emergence Effect. And we thought that was really great. Then we started to think, what does that mean? And as we talked to people, we kind of pulled together this graphic which describes what we think people are talking about. We absolutely have a focused vision around how you build cloud companies, and we help our companies really look across the industry and draw on that learning that we've generated. And I think we absolutely have helped our companies position themselves in the cloud ecosystem for success. We absolutely have a network of folks in the SaaS industry that we are able to draw from as we help build these companies. Again, we've already had the benefit of having success at Salesforce, which has then led to some of the really great people there joining some of our other companies, and so on and so on. We really believe in partnering with the executives, so we're not kind of VCs who drop in every once in a while just to see what's going on. We have regular phone conversations and lunches and breakfasts with our executives because we really feel like we are a partner with them in building these companies. And then go-to-market SaaS expertise. I think we are really focused on accelerating revenue, and I would say we're not the guys who are going to help you build a killer product. We think that that's really the role of the entrepreneur, and that the time that when you take on venture capital, that's the time to really be putting your foot on the gas and accelerating the sales and marketing traction. So that's really where we tend to focus. So as I mentioned, and this is cut off a little bit, but there is kind of a pattern in where companies develop and what kind of capital they should be pursuing. So if as a company gets started, they're really starting from scratch on their management team, on their product, on their sales organization, and where they are with customers. And as a company grows, they tend to need more money as they grow, and they start to build their organization and eliminate some of the risks that investors see. So when you start, typically it's just a founder. They have a concept. They might put together a wireframe, but they really don't have any sales, and they're really just going on a theory or maybe a lot of customer input on what is going to be a killer product. As the company develops, it really has to develop on all of these dimensions in order to make it to the next level. And when you make some decent progress in each of these categories, you typically find you need more money, and you then need to approach different kinds of investors to get a bigger pot of money. And of course, there's the Series A, and then the Series B, and then finally there's the growth stage investment, which each requires more and more money. So what we find is sometimes entrepreneurs don't always understand this, and they aren't talking to the right people to get the money and the help that they need. So one way I would interpret this chart is if you can identify your company in one of these columns, that's the pattern that the investors are looking for at that stage. And in particular, I would say if one of these if one of the rows is lagging behind the others, that's a problem. Typically, if you think you're in the Series B column, yet you are really not yet developed in one of those dimensions, then you're not going to be successful raising money from those particular investors. In fact, you're typically going to be one column behind. And so sometimes VCs talk about you can imagine an A+ company, but VCs tend to call them B- companies if they're in that B column, but there's something that's not quite up to snuff with respect to that pattern. So VCs look for these patterns, and they raise funds in order to invest a certain amount of money. So it doesn't really work for a VC to invest in different columns. Their fund determines the amount of money that they can invest, and therefore what the pattern they're looking for. I'm going to drill in a little more on the sales row because I know this is a sales audience, and I think the people in this room have a lot to do with moving a company along this chart and progressing to greater and greater levels of success. So these are some of the things that we look for in sales traction. There's sales traction and there's sales traction. Sometimes companies say, oh, we have great traction, but the VCs are looking for certain things that are more meaningful to us. And I wanted to just give you some of those insights. So customer references, I mean, that is really important to us. We are looking for companies that have really solved an important problem that customers are getting value out of. And we are looking for companies that are not just piloting software or piloting a solution, but really have internalized the value and are getting use out of it in a production environment. We're also looking for customers that have really done their homework and learned about the various options in the marketplace and evaluated them and then selected this solution. We're less excited about when we call references that say, you know, I've never heard of the competitors. I've never evaluated them. Or I bought this because my brother-in-law is the president of the company. Those are not the kind of references we're looking for. You know, rapid bookings growth. This is, it's one thing to sell some customers. It's another thing to put all the pieces in place to have a pipeline so that you can book a lot of customers this quarter, even more next quarter, and even more the quarter after that. That is hard to do, but when we see that, we know that when we invest money in a company, they can turn our money into even greater pipeline, and with the ability to close that pipeline. So we're looking for all of the pieces being put in place so that a company can take advantage of the capital that we're investing. High renewal rates. So those of you who really understand the SaaS industry, it's all about recurring revenue. And if you have a leak in your bucket and your customers are leaking out the bottom, you just have to put a lot more in the top. And we believe that this is an important dimension to pay attention to so that all the sales you're generating are adding on top of your install base, not replacing customers that you've lost. Pricing power, I should mention, it's often hard when you're starting a company to know where to price a product. So we love to see companies that have been able to increase price and still get the customers to buy. That's a great sign that you've got a compelling solution. Significant ACV values, and this varies by who you're targeting. So we know that you'll never sell a really $100,000 deal to a small company. That's not the right framework. But for a big company, you need to, we really want to see those kind of values because, again, it indicates the importance of the solution to the companies. The mid-market, is going to be more price sensitive, and you're not going to be able to achieve the same price levels, but this kind of gives you a feel for what we think is appropriate and exciting from a ACV standpoint. And then finally, efficient customer acquisition. So again, we're looking at what happens when we put money into a company, what are they going to be able to do with it? And we know that you can sell anything if you put enough resources against it, but of course we don't really want to spend our money that way. We want it to go a long way, and so we do look at sales efficiency. I think there's a quick rule of thumb: the ACV divided by the customer acquisition costs, around 1 is kind of a standard in the SaaS industry. Typically when you get started, it's going to be higher than that, maybe 1.5 or 2, but we like to see it improving, and with scale, typically you get those efficiencies. And that ratio is kind of a quick way to assess how you're doing. By the way, when we look at customer acquisition costs, we're looking at the total sales and marketing costs in a quarter. So we know that there's sales costs, we know that there's marketing costs, but you really have to sum them up to understand your customer acquisition costs. Channel partners, Heidi talked about this. This is a form of sales efficiency. If you can get some of these deals in place where other people are selling your product for you, you can more quickly build a footprint and you can more quickly get sales. And then freemium is kind of a special case, I think, in SaaS sales. We've seen some great success in that model, and you have to measure it a little differently. But we don't think freemium works everywhere, by the way. But where it works, it can be extremely efficient, and almost always it involves some kind of viral growth, and that's really what causes the engine to keep going. So those are my comments. I mostly wanted to leave time for questions. So again, I'd love for you guys to come up to the microphone and ask anything you'd like. Why don't you come up to the microphone?
Brian, thanks for coming out. You very well respected within the industry, obviously. So thank you. My question was, what revenue do you need to see at those different stages? So like Series A for enterprise, B2B platform, what kind of revenue you want to see there versus Series B? So as us as sales leaders, we can see what numbers do we need to hit in recurring revenue. Also the impact on like 2-year contracts, 3-year contracts that we can get that especially early on? Maybe we can get a partner who's seen the value to commit 2 to 3 years.
Yeah, that's a good question. We really don't look at a particular revenue number as a threshold. I think we're thinking about it more in terms of this this progression of sales. So what we like is product market fit, and that's kind of hard to assess. But if we see 5 customers or 10 customers who are really getting a lot of value out of a product, that tells us that we don't have to worry about maybe the product doesn't work. That's one of the key risks. This other comment about starting to build your sales organization. If there's one salesperson, that's a risk for us. We need to build a sales leader. We need to figure out, is this salesperson unique, or is he following a certain process that can be replicated? So it's really about the development of the sales function as opposed to a specific revenue number.
Okay.
When you talked about ACV on the SMB, 25K plus, around 25K, is there a number below that, let's say 10K, 12K, that you really start to worry about and highly question in terms of having a scalable business?
Yes, I think when you get to very small numbers, it becomes a question of, is it possible to really scale this efficiently? We know from experience that if you're going to field an inside sales organization, you need a certain level of ACV in order to just make it efficient. Now, there's always exceptions to every rule, and I think particularly in like the freemium model, you don't need those levels because you're not fielding an inside sales force, or at least not with the same kind of economics. So there is, at a certain point, we do ask ourselves, gee, there's a lot of people who bought this for $5,000 per year, but how are we actually going to scale it up? And again, we're always looking for innovative sales and marketing techniques. So if someone finds a way, and there have been some companies that have very innovative sales models that might be able to tackle an issue like that. But in general, those feel like special cases to us.
That was really helpful, but one question we often come across is VCs say that's not a $1 billion market. How do you kind of get around that? I mean, it might be in the future with more features, etc., but currently it's not a $1 billion market. What do you...
Yeah, that's a great question, because most of the stuff you can change if you work at it and you have money, and some things you can't change, and the market size is one of those things. So when we come across a company that just has a small market, that is a deal killer for us in many cases. There are a few things you can do, and I can't. It all depends on your specific situation, but we sometimes talk about layering the cake, and what that means is if you have a solution that your customers love you for, they're kind of giving you permission to sell them other stuff, and so one way to expand your market size is to add functionality or additional modules that appeal to a broader audience, or deepen the share of wallet that you're getting from a particular customer. So that's one technique that I think is something you should think about. It's a double-edged sword, because if you can kind of ruin your position in one market by confusing the market with a different product. So it all has to fit together. But it is true that VCs look a lot at market size, because most VCs are investing, between $3 and $10 million, and we're trying to get multiples of that amount of money. There's nothing wrong with having a product that targets a smaller market, especially if you can do it on less than $1 million in investment. That can be a great company for you, for your angel investor, but it would be a bad company for a venture capitalist. So, again, don't go to somebody who's not going to fit what you're trying to build.
Thank you.
Great presentation, thank you. you see a lot of tier one deal flow from the top entrepreneurs. Could you comment on the percentage of inbound versus outbound sales, lead generation, as well as different parts of the funnel? Like how much are tier one entrepreneurs really outsourcing the lead generation, the pre-qualification process? How common is that?
I would say, in general, we are investing in companies that control their own destiny by managing the sales and marketing process internally. In many cases, they will add on channel sales or some form of partnering, but it is a risk for a VC to invest in something that's outside of our control. So in many cases where we see those opportunities, we say, well, don't you want to also build a small direct sales force so that you have direct contact with your customers?
In terms of, I guess, lead generation and qualifying, do you see, a lot of this conference is around those kind of innovative techniques. Do you see that applicable, or do kind of a lot of companies make up for that by just raising more money? Like, what's the trend right now?
I think I would say we see both inbound and outbound lead gen working. I think there's not one answer there. I think we do look at the efficiency of lead gen because, again, if you spend enough money, you'll be able to get to anyone on the planet and convince them to buy something. But that's not really a scalable business model. I think lead qualification is, in the last 5 years, we've seen many of our SaaS companies implement a lead qual group in their organization as a more scalable way to to really feed qualified leads to the sales force and have them more focused on selling than qualifying. And that definitely feels like one of the trends.
Thank you.
Hi, Bob Marsh from Level 11. As you invest in a number of SaaS businesses, is there a ratio of subscription versus professional services in terms of a ratio where professional services is too high? That's a concern?
That's a great question. I think it is true that if you have too much professional services, it can work against you in the long term. One of the reasons for that is professional services is a non-recurring form of revenue. So if you have a high degree of professional services, the following you can report the revenue, and then the following year you got to fill in that bucket with even more. And so that's, I think, one of the key issues with having a high degree of professional services. Also, there's the value of the company can be affected by the level of professional services. So in general, consulting firms are not worth as much as SaaS firms. And if you really need a high degree of professional services to make your customers successful, you may be valued as a consulting firm. And so we would like to see around 20% or maybe 25% max professional services. And then it feels like it can help you make your customers successful without penalizing you. Now, I think there's really one great important exception to this rule. It's Viva Systems, which went public yesterday. They have a lot of professional services. And as they were growing, we were wondering, is this a good thing or a bad thing? What they've been able to show is that they've signed some of the biggest companies in the world, Novartis, Genentech, Lilly, Pfizer, and they are doing implementations across tens of thousands of salespeople at a time and on a global basis. And so we've seen, as we've brought on major customers, this lump of professional services go in to make those companies successful, have it decline, and then see a nice growing recurring revenue stream from the subscription. So, as I said, there's an exception to every rule. I would say in general, you don't want it to get to be too big, but there are companies that have worked around that problem.
Brian, as you look at your portfolio and sales structures across different types of companies, have you seen or do you recommend one specific sales model working better than another? As you look to give advice to your portfolio?
No, I think there's a lot of variety and room for innovation. So part of the thing about SaaS is that in the old days, most software was sold to the CIO in a large organization, and so there was a single buyer, and the companies of that era learned how to sell to that buyer. But today with SaaS, one solution is sold to the CFO, one solution is sold to the VP of sales, another solution might be sold to someone in ops, and so forth. These are all different buyers. They have different buying mentalities. They have different pressures on them. And so it would be great if there was just a cookbook for how you sell SaaS, but actually I think that's also the opportunity, is that with SaaS you can find a buyer that's maybe never bought software before. And that's a problem, but they're not being pounded on by SAP and Oracle every day. So you might become the go-to person for that particular buyer in an organization. And so, but that you need to figure out, how do you generate those leads? What are their key criteria for buying? How do I reach them efficiently? In general, a smaller ticket, smaller ACV is going to be more of an inside sales, and at a certain point, for very expensive solutions, it's going to require a field sales. But I also think there's room for tons of innovation.
I just wanted to find out your thoughts and value on vertical market fit versus a horizontal product.
That is a great question. Our thinking has really evolved on this. When we first started investing in SaaS, and our firm was formed in 2003, we thought, gee, SaaS is like client server, so it's just like knocking out Siebel and putting it in Salesforce. So the big companies are going to be these horizontal software companies, and the verticals are going to be smaller. Viva was one of our first vertical investments. It's a $4 billion company today. I think they've done a nice job of showing that you can build a really valuable company with a vertical approach. And we believe that SaaS opens up that opportunity in ways that client server didn't really make it available. Maybe I could talk, there's some stuff on our blog about this, so I'll just hit one or 2 points, but here's an example of this. SuccessFactors was one of the first companies we saw that they were competing against PeopleSoft, and PeopleSoft sold software to the HR organization. So when someone bought PeopleSoft, they bought licenses for all the people in the HR organization. SuccessFactors lowered the price of HR software and said, no, this isn't just for HR, it's for every employee in the company. And when you have to lower the price in order to make this work. But when you sell to everyone in the organization, that is a bigger opportunity than just automating one department. And I think that's absolutely the direction of software, and that opens up some vertical markets. We look at some vertical markets where no one sits at a desk. Think about transportation, healthcare, retail, education. There's a lot of workers in America today who do not use software. And with the advent of mobile devices and vertical solutions that really meet their needs, we think that's a much bigger opportunity than it was 10 years ago.
Awesome. We got a break right now for coffee. These are great questions, but we're going to resume again at 3 p.m. Just so we can give everybody a break before we get to the next 2.5 hours of session. So,
Thanks, everyone.